Today I have Mr. Paul Bratby. Mr. Paul Bratby is the CEO of xBratAi and is an excellent guest that I have today because he has spent 30 years watching this, in the trading sector, what's, in the failure mode, which repeats across every market cycle. What's interesting is he's a former British, Army engineering manager that has turned into a professional trader, and he learned very early in the field that the worst outcomes in the high pressure situations come not from lack of information, but from committing before multiple independent signals genuinely converge. He calls this principle confluence. And today I would like to, introduce my guest and to understand what is this new concept about confluence. But before we get into that, I would like to also understand from Paul and would love to know his story. How did he go from, being in the army to going into trading? Because that's a completely different vertical altogether. So welcome, Paul, to the podcast.
Thank you, Sandra. Yeah, it was so joining the army, I was 17. I wasn't even an adult then. So that system to beat emotion was drilled into me. I had no choice from a very early age. And I think at some stages during anybody's career, not everybody follows the same career path for their whole life. I started my side hustle trading when I was still in the army, and at some point, I got really good at it, and I could see that there was a career change that needed to happen, and confluences occur in life as well. We have to choose those paths. And that was the fork in the road that I chose to leave the British Army, even though my career was going very well. I've just had a recent um, um, we all got together 40 years after we joined the army just this
Wow.
past weekend, and some of the
Wow.
guys continued with their career up until 2 years ago.
Mm.
But I made that decision because I'd found something that I was good at and that really resonated with me. So I made that decision in life to take that different path.
So tell me something like I'm sure that being in the army it must have shaped you already in terms of risk discipline. So was it easy to then become a trader in the beginning and look for strategies that way? How were the early days like and how did you like get into what you are today because you wrote a book as well. That's also something I want to emphasize on. So going all the way from that journey to having a book today and having an app today, it's an amazing journey, right? So how was that
Thank
like?
you. So the army taught me that systems beat emotion at the end of the day. You assess risk before you act. You follow tested rules. You train for those rules over and over again. It's like building that muscle memory, and you stay calm under pressure. Markets reward rational responses, not reactions. You should
Hmm.
never be reactionary to markets. And I was an engine. The first 2 years of my army career, I was an apprentice. I spent a
Okay.
lot of time, we were it was something called bench fitting out of steel. We were making F clamps by hand with steel and a file. It took a lot of discipline, a lot of accurate type measurements, and also patience. Okay, well,
Right.
these things take a long time. So in the army, you never improvise when the pressure hits as well. You fall back on what you've trained for.
Yeah.
Trading is identical to that. Before any
Hmm.
trade, I already know where my stop is, my exposure. What if it goes wrong? How much am I going to lose? It's that engineering mindset in action that takes control all of the time.
Hmm. Just to pick up on that, right? Your core idea of the app is also, confluence, not coincidence. And I've looked at the app, and it's a very interesting app. I had a great fortune of using it. Wanted to understand in a simple, basic laymanized language, how can one understand that concept? Because I believe there are a lot of you have used the concept of F1, signals also on it, red, yellow, green. So how does this all come together and how did you come about it?
Okay, so confluence is really when several independent strategies all point in the same way. So it's not about stacking 10 indicators that say the same thing. One clue is interesting, four non-correlated clues are a trade. So, think of it like building a court case. One witness is a weak case. Four independent witnesses telling the same story, that's a conviction. So, for example, trend, momentum, bias, volume, all lining up is confluence. Three oscillators agreeing in just the same opinion three times
Right.
is not really anything that is any good. Most traders actually just try and overcomplicate things where if you have a confluent set of rules. Now, don't get me wrong, to do this manually is quite complex. I was doing it for so long, I made it look easy. But the app
Right.
is there now to simply, when those non-correlated strategies all line up, it lights the lights up like a Formula One starting grid. When you get
Right.
five green lights, all systems green, push notification, you go long.
Hmm. Interesting. Speaking of Formula One, which is your favorite team?
I think I'm torn because I've always been a Lewis Hamilton fan. So
So you're a
right back in
driver,
the
so you look at more driver perspective and not team perspective.
yeah. So Lewis, I followed him from being a McLaren driver, obviously Mercedes, and now he did very well in Monaco this weekend, Ferrari with second place. So I love McLaren right from the beginning anyway because it's a British team, but Lewis is my driver as well. So I've got lots of different shirts and hats.
What's your take on who's going to win this F1 by the end of the year?
I think Kimi Antonelli will be he's already breaking records already, so I think he's going to be the one to beat. So this prediction early on is very difficult. As long as he doesn't get any breakdowns or major crashes, I think he's going to win this championship.
Interesting. And thing is, taking on that, working on that queue of yours, is it when we do also trading, are there signals like these that, retail traders get, or are there like hidden signals also? Because like you said, like how in F1, maybe a car breaks down or something or the other happens and then the driver may not be able to perform. But parallelly, when retail traders are also looking at, indicators, data, there's so much that they are looking at. Do you think that signals for that matter tend to be an overload and actually something else that's the problem? Is it the strategy or something else?
So more data doesn't mean more clarity. It usually means more hesitation. So, for example, in the crypto market, it never sleeps. So traders end up being, it's end up with confusing activities with actually an edge. The fix isn't more signals; it's better filtering. Okay, so 10 screens won't make you a better trader. They'll just make
Hmm.
you a busier trader.
Okay.
Most blown accounts aren't from too few signals. Sorry, they're from reacting to every single move. A
Hmm.
Formula One team will download the data, will filter that data and present that data on a screen that makes sense. It's there's a hell of a lot of data that come from a Formula One team. We look at 100,000 different confluence combinations per instrument, and very soon we'll have 55 instruments. It's how to filter that to something that's meaningful and that gives you more clarity.
Interesting. So coming to the platform, right, specifically now, I believe, and I've used the platform, so I really love the functionality. It's very simple and very basic for even for new traders to use, although it requires, great amount of patience for the time for, the signals to come in. I believe we have Forex, we have futures, and we have cryptos. Any ideas on, when can we get stocks
So
as an asset class?
stocks is in version 2 and it's coming out this weekend, which will be mid-June. We have 15 sort of high volume stocks, so they're
Wow.
tradable every day, and ETFs as well. So your things like Nvidia, Tesla, Apple, Microsoft, the
Mm.
Qs, SPY, that sort of thing. But also we're adding five more Forex pairs and five more futures pairs as well. Things like platinum, natural gas, copper. I used to trade copper professionally, so there's a lot going on there. So now we're going from 30 instruments to 55, which includes 15
Wow.
stocks and ETFs. So there's a lot of work for databases and servers to do, but in reality, it's still the same simple user interface for traders.
So across all the asset classes, from your perspective, since you have also been a trader, which is the most toughest one to trade for?
So crypto for me is the toughest for retail traders. It's a 24/7, it's fast, it's emotional. There's no natural pause. So it
Mm.
exposes weak discipline faster than any other market. Forex futures and particularly stocks, they at least give you a session and economic data points. They give you structure during the day and during the week. They're natural start and stop points where crypto never lets you breathe. So it's a trader who's fine in futures can actually fall apart in crypto simply because there's no closing bell to save them. There's no structure to be able to define that day. So when we're looking at commodities, for example, there's a gold pit open every day. There's an oil pit open in the US. There's structure. We know when there's more volume going to come into that. But with this 24/7 crypto market, it's very tough because it will react on news, not necessarily economic data. It's not structured in that way. It will take a news event somewhere or a big push on social media, and then all of a sudden it moves again. So it's very difficult to have that structure for crypto.
Fair. I've always been inquisitive in these markets, and that is where I want to, take this opportunity to ask you, where does the opportunity really lie in terms of asset class? Is it really in the mature markets like a Forex or oil or oil futures or something like where you can ride the volatility like a crypto? So where does opportunity like I'm sure both, right? But what is your perspective on that?
So if you'd have asked me this question 5 years ago, I would have said, you learn an instrument and you become very so for example, copper. Yeah, copper futures.
Mm,
It's a
mm,
mature market. And 5 years ago, and when I first started trading, technology wasn't as advanced as it is now. So you had to concentrate and learn that behavior, how it behaves on certain days, what its correlations are with oil, with the US dollar, what economic data makes it move, all of that sort of thing. That was 5 years ago.
right.
But now we see technology like xBratAi that gives you multi-asset exposure without having to learn the behavior of each individual instrument. So what you can do is
Mm,
rely on that and have that
mm,
multi-asset exposure. So at some stages, a lot of commodities will be quite flat, but crypto might be
mm,
moving. Every day, a stock
mm,
market opens and you get high liquid stocks tradable. So, yesterday we had a short on Amazon on the testing. Fantastic trade, took it all the way into the close.
mm,
So having that multi-asset exposure is very, very important for traders nowadays because you don't need 10 screens with loads of charts and lots of tools, and you spend all this time trying to learn one or two instruments because, to be honest, we're human beings, that's all we can do. Use the
absolutely.
technology like xBratAi and have that multi-asset exposure so you've got that continual trading opportunity during the days. So don't
Mm,
get emotionally involved with a specific, I've got to trade Forex or I've got to trade crypto. Sit back, allow the confluences to happen in multi assets, wait for those signals to come in and trade those. Yes, you're going to have to do a little bit of work in perhaps getting a multi-asset broker, and we are working with some of those right now because it'd be great to have all of those assets in one particular brokerage. It's not that simple. But the only muscle memory you're going to have to learn now with that technology is to wait for that specific instrument on an asset class, whether it's crypto, Forex, futures, stocks, an ETF, it doesn't matter. Wait
Mm.
for that to come in. The muscle memory you need to do is be able to then open up your order ticket on your broker and put the order on. So that's what you need to learn. You need to trust in the technology that, I literally wrote the book and it's sold all around the
Yeah,
world.
yeah, yeah.
So before the book, I was trading it 20 years, and the 10 years leading up to the book, I developed the software to make it simpler. But we've gone one step further now. You don't need all these screens. You need you just need the lights lighting up and the push notifications. And what you need to learn is how to put that order on and adjust orders for locking in profit when we send those push notifications to adjust the stops.
Now, let me ask you this, right? I completely get what you're trying to, what you're trying to convey in terms of what the app is trying to, say in terms of how do you enter. But there are a lot of times also you must be knowing as a trader, it's not about when you enter, it's also about when you exit, right? So does the app, help you to understand that, this trade should not be picked up, or maybe you need to pass this wave, or something like that, it's too volatile, you don't know what's going to happen and stuff like that, or maybe you need to cut loss or
Yeah,
stop
so the
loss or
AI's
something.
job isn't to fire endless alerts, okay? It's not that. It's to eliminate the weak setups at the end. So
Hmm.
filtering matters more than firing. Yeah, that's
Hmm.
probably a new saying. Done right, AI removes noise for the trader instead of
Hmm.
adding to it. So, we process over 100,000 different combinations for every asset
Wow.
every weekend, and then we throw most of those away. Okay. And then there's like a top three, and then the algorithms are programmed. There's 28 points of control from that 100,000. It's a filtering system. But we, so when the lights light up, it's a very high probability trade. And we're not firing loads and loads of signals. Today, we've probably fired 3 signals out of 55. Okay, so far
Oh, okay.
today. Yeah. Natural gas is in right now, and what it's doing is sending a push notification to adjust the stop as price moves to lock in profit. So we don't leave you alone. We don't just send you a signal and say, hey, you got to deal with it. We give you a stop loss, and then, whether it's 30 minutes, 40 minutes later, or sometimes 10 minutes later, if it's moving fast, we send a push notification with a new stop price. So you keep adjusting
Hmm.
the stops to lock in profit all the way.
Hmm. So, but there's so many, asset classes, and there's so many data sets. So how do you prevent that from, creating so much noise with the data?
So we have very strict rules. So, besides all those different combinations, which have rules anyway, we have then the 28 points of control that are programmed by the AI for the algorithm. We have then a separate AI running with internal logic live. So there are timeouts, for example, is very, very crucial in Confluence. So just because we've got 4 out of 5 lights doesn't mean we're going to go long or short. We need that last piece of the puzzle. Imagine a river. So a river only turns into rapids when you get lots of tributaries feeding it in a very short space of time. If
Right.
those tributaries are far apart, the river
Right.
initially gains momentum and speed, but then slows down again before another tributary feeds it again. It's too far apart. What you need is those uncorrelated signals coming in within a specific time. Our AI will change that time depending on the time of the day, what economic data is coming out, how the correlations are. So we need those tributaries coming in reasonably fast to make sure those rapids, that that directional momentum for that particular instrument is strong enough to move.
Hmm. Hmm. Um, is it that, today with so much of, I mean, you also built an AI infrastructure around the app, and there's so much of AI people also use by themselves now. So has there been a case that does now, or are we still looking at the same metrics like win rate, number of signals, risk adjusted returns, drawdowns, or, the filter qualities? Are there still these metrics that are relevant today, or has the game changed?
I think it's changed slightly. The win rate is one of the most misleading numbers in trading. Forget signal counts. Look at drawdown control. Look at risk adjusted returns, quality of the filters. That's protecting your capital. A 90% win rate means nothing if the 10% that you lose wipes out your account. Okay.
Wow.
So you could win lots of little trades, but then your 10% that you lose can completely wipe out your account.
Wow.
So expectancy matters more than being right. You know, um, ask one question of any system: does it protect me from bad conditions or push me into them? That's the thing. So one of the data sets that we always look at is the average winner against the average loser. And
Mm,
we really want to make sure that our average winner is a lot more than our average loser across every single asset. As long as we're weighted that way, even if we had a 60% win rate, we would still be in profit. Rather
right.
than taking lots and lots of small trades where your average winner is very small, but your average
Mm,
loser is huge, that's
mm.
not mitigating risk. Okay. So sometimes the win rate is misleading. So if somebody headlines with a win rate of 90%, that's not the full picture. You really risk adjusted returns, drawdown control is very, very important now, especially with multi-asset exposure.
Has there been any case where, since our app gives a lot of signals, right? There are a lot of flashes that even I was using it. So, is there a case where, could you help me understand that, let's say there are different asset classes that start to, flash as notifications. So there could be a conflict of, I'm not going to say interest is wrong, but conflict of, should I go for this asset class versus A asset class or a B asset class? Can there be a situation like this?
Remember, everything's correlated. Everything's joined by very thin strings in the markets. Okay, so
Hmm.
those correlations are very important, and a lot of them are tied to the US dollar. That whether
Hmm.
people like that or not, that what it is. That's what it is. So, for example, when the S&P 500 goes up, gold goes down. That's the inverse correlation that we'd normally see. There's correlations like so in the London Open, we have a positive correlation between copper and oil. But in the US pre-market and the US Open, it's a negative correlation. So
Hmm.
those correlations are like a spider's web. So choosing which one, I can't choose that particular stock because I'm going this. It's all about,
Hmm.
again, have you got the margin to trade every single signal? Okay.
Right.
Um, that's the thing as well. So it depends on your account size, what your risk is, of how much you're risking per trade. But smaller risk with taking trades in every asset class gives you greater exposure to those different asset classes, and more likely to grow that wealth quicker rather than trying to hone in on one particular asset class. Now, it's not available for everybody. Don't get me wrong. Some people won't want to go on and VIP and trade all asset classes. They may want to concentrate on Forex and things like that. That is their personal decision, and a lot of that decision comes on the time that they have to trade, the money they have in their account, and what they're prepared to risk.
So at the same time, don't you think so? Just to, be slight, just pull that answer a bit more by saying that, don't you think so is also the own independent research of the trader? I mean, of course, the lot size and margin size does matter, but the independent research would also matter of the trader, isn't it? Rather than just focusing on A or B as asset classes and then
Let's
play to
not call it
strengths.
research, let's call it due diligence.
Okay, fair,
Yeah.
fair, fair, fair.
So I think that a trader, if he's going to trade all asset classes, needs to have a general understanding of how each asset class works. So for stocks, for
Mm,
example, we have and we're only doing US stocks and ETFs because they're the most liquid, but they
mm,
have an open, a high,
mm-hmm.
a low, and a close. And each stock has earnings coming every quarter. So understanding that little structure of the stock market, and particularly there's only 15 stocks and ETFs on the app, do your due diligence on each one. What type of product are you going to use to trade those stocks? Are you going to trade options? Are you going to trade contracts for difference? Are you going to trade these new tokenized stocks, which a lot of the crypto brokers are doing? So a lot of that due diligence comes at the beginning. And again, I go back to that muscle memory. So again, you may be trading futures with a specific broker, but then you may be trading spot Forex with another. So I think a lot of this due diligence comes in building the foundation to begin with. If you're just going to
Mm,
trade Forex, you've been trading Forex for a while, you're going to use the xBratAi for signals for the Forex, you already know how to do it. You've got those spot trades, you understand how the Forex market works. And the same for futures, the same for crypto. But if you're going to start to combine and have that multi-asset exposure, which to be honest, my personal opinion is the future for trading, because that gives you that continuous trading opportunity, you need to take the time to build the foundation in each asset class. Learn the overall sort of overarching correlations, economic data,
mm,
how that affects it. Um, you know, look at go to anywhere, even on TradingView, there's an economic calendar. Understand when those big data, we know CPI, PMI, that sort of thing. You know, it doesn't matter what you're trading. You need to understand that economic data calendar because that will ruin a trade, enhance a trade, and it will give you a reason not to. So we've helped a little bit with that in that if we've got an instrument already in trade and we're 15 minutes for a big economic data point, guess what? We send you a push notification to saying, actually, it's a good time to take your profit now before the risk of
oh,
economic
wow.
data.
Oh,
So we
wow.
try and
That's
hold your
insane.
hand with these bigger economic data points. We
Amazing.
even hold your hand if we're in a really good trade and it's starting to run out of momentum or it's going to be hitting a big institutional resistance zone. Guess what? We send you a push notification that we're closing the trade now. So
Insane.
we're trying to take a lot of that learning away, but it's still good to build that foundation. But I wouldn't call it
Mm,
research. Don't go down the rabbit hole of spending weeks and weeks and weeks trying to learn
yeah.
everything. Do some
Mm,
due diligence and get, I don't know, 10 bullet points per asset class that's going to be very, very important.
mm,
Correlations. If one goes up, the other one should go down. If they're both going up at the same time, oh, there's something not quite right here. Yeah. You look at the four US stock indexes. If they're all green and all going up, fantastic. But if one of them's red, so if the Dow Jones is red and the others are green, there's a bit of sector rotation and that could flip at any time. So just be careful. Very basics, just don't go too deep but understand that foundation and most importantly understand how to put trades on what type of product you're going to use to trade that instrument and understand your risk.
that's a very succinct and a very, at the same time, in the right way to, or the right approach to, absorb it from you, considering I'm assuming these things are not in the book. So this very interesting information, I must have gotten it from a premium advisor.
I do have and we'll give you a link for that. I have an expat academy. And the
Right.
essential module for that is
Okay.
everything you need to know to trade markets, correlations, economic datas,
Interesting.
behavior, volume. It's an essential module really that I put together to help people truly understand that. So in the army, we actually understand the battlefield. We understand that operational landscape, as we call it. Yeah. And there's an operational landscape for trading. And that essential module on the Expert Academy is all about understanding that operational landscape. You do not go into battle without understanding that operational landscape. You do not
Hmm.
go into trading without understanding that operational landscape.
That's a very interesting way to put it. I have just last two questions for you. In these 30 years, that you have been trading, there are a lot of volatile markets, especially in today's time. There are runs, there are crashes, there's so much. And in this time, we try to book profit, we try to cut loss, we try to, figure a way to come to mean reversions or try to even overtrade for that matter. Across all these probabilities of or these tendencies of what a trader goes through, what's the core psychology from your standpoint needs to be there if you just ignore all these emotions and these behavioral biases that come?
Yeah, it's a very difficult one because we are human beings at the end of the day with a lot of, each individual has their own sort of pulls where, so over trading is just an emotion in disguise, really, greed in a bull run, fear in the crash, all these sort of sayings, and the urge to always do something is there for a trader.
Right.
Missing a trade is harmless. If you miss it, you've not lost any money. Okay. Taking bad trades over what, wrecks it. One of the biggest things for me, and I always say to people, is you've got to learn to sit on your hands. You've got to
Okay.
learn to be patient. You can't be a busy trader moving a mouse and making things happen if you're sat on your hands. The
Right.
markets will do their things. Earlier on, we talked about traders that use probably 10 different indicators that all tell the same story. And, that's a busy fool. Okay.
Mm.
Um, that's somebody that's trying to look for a trade when in reality you need to find a reason not to trade. So if you've got a specific set of rules and a checklist, when I first started, computers were new, 386 SX Pentium, the big
Of
things.
course.
I had
They used to have
printed
like
out a checklist,
these big,
big
yeah, big, yeah, big
monitors with a
ones. Yeah, yeah.
desktop with a 3.5-inch floppy disk and all that sort
Yeah,
of
yeah,
thing.
yeah.
Yeah. So, the computing power wasn't fantastic. So I would have a checklist
Oh, wow.
right from the early on, and I would check. And if all of those things were not checked, there was no trade. Okay. And I didn't have this 20-page checklist. It was five. Yeah, it was five things. And this is why we have five lights now on the app. Yes, there's 28 points of control feeding those five lights, but for a simple set of rules, it's very, very, the more emotional the market gets, the more your routine and rules need to take over. Okay. So, for example, crypto is a very emotional and sort of volatile market. And your rules really need to take over then. And one of the biggest rules for me is sit on your hands. Don't be a busy fool. Okay. The market will be there tomorrow and the
You
next
may not
day
be
and
there
the next
tomorrow.
day. Yeah,
Yeah, but
yeah.
you may not
Survival
be
and
there tomorrow.
consistency beat excitement every day. A boring trade that you start off and sometimes you're in that trade for 6 hours and all you're doing is adjusting the stop every 16 minutes just to adjust that stop to lock in more profit. That boring trade is the one that builds wealth. The exciting trades where you're trading 20 times a day, they don't build wealth, they build frustration, eventually give you a heart attack, and all that sort of thing. So it's about being boring and sitting on your hands and waiting for confluences to happen. They will happen.
I'm assuming on a fair side, of course, on a lighter note, that in these 30 years, you may have had lots of experiences of those, going for these exciting trades versus the boring ones.
That's why I've got no hair left. Uh, so yeah, I think I've learned by making those mistakes. Now,
Right.
in trading, I'm not. You can lead a horse to water, but you can't make
Right.
it drink. So somebody
Hmm.
listening to this podcast can say, okay, he said sit on my hands, wait for the confluence to happen. Don't overtrade. Don't put lots of indicators on the chart. I can say those things. I can lead you to the water, but I can't make you drink. Okay. So
Hmm.
I've gone through that. I've come out the other side. I've developed a very, it was, those epiphany moments, and a lot of it was to do with engineering and military discipline that made me get that structure and those set of rules to build that confluence strategy. It's that took over uh, after those sort of exciting times that actually never made any money, blowing accounts and things like that. So,
Wow.
you know, when we're young, it's pretty difficult to take that advice.
Hmm.
But so it's very, I think you've got to survive. You've got to have that consistency to beat that excitement. You've got to be dull, you've got to be boring, and you just got to make money.
Interesting. I have one last question for you, and this is, something just because I really loved our, conversation. This is something from a personal level I wanted to ask. You know, across all these years, what was that maybe one trade or two trade? It could be a boring trade, it could be an exciting trade, it could be anything from your experience, a story where you felt that, I'm great at this, or this is something I want to do, or it could be the other, I'm not going to ever do this, but still you went at it. So which emotion was more all these years, and yeah, what's the story? I wanted to know.
So one trade that I'll always remember, and this was, oh wow, 17, 18 years ago, was a stock.
Wow.
The ticker was CIG. Yeah.
Okay.
And in those days, Elliott wave was my thing. I wanted to trade the trend, so I waited, in those days before I actually developed the first Elliott wave software, we measured the wave 4 pullback, that profit taking pullback. And there's
Hmm.
lots of rules that has to be met. And I won't go into them now, but they were all met. And I went long CIG. I didn't
Hmm.
take it out at the fifth wave target because it went into that fifth wave target with momentum and it just kept going and going and going and going. And we're talking months. And then
Wow.
it had another, then it formed a new wave 3 because it had gone way farther than the original wave 3.
Right.
I waited for the wave 4 pullback and then I added more to it and it kept going. But
Wow.
then when it hit the next fifth wave target almost a year later, because this was a swing, um,
Hmm.
it went in with lower volume. Okay.
Right.
Um, so I took it out. I then traded the reversal short and it worked out. It was
Oh,
about
wow.
being patient. That was the biggest trade. Another big trade, and I talk about it in my book, was the pandemic pullback for Microsoft.
Okay.
Um, so during COVID, there was, I mean, obviously, I've been doing it a long time. So shorting to feed the investing pot is something that I still do now. So when there's
Hmm.
a shorting opportunity, I will use something like options or CFDs or something like that. And I will never, so Microsoft, I didn't sell. I kept a position on the pandemic, but it was a structured profit taking pullback that was happening. So I shorted Microsoft and with a
Wow.
margin product on
Oh,
a wave
wow.
4 pullback. And then it hit
Insane.
all the criteria after that pandemic
Okay.
pullback. It hit support. And guess what? I used that free money because it is free money because I used a margin
Yeah.
product short. So it was
Yeah.
profit. I used that
Right.
free money to buy more Microsoft stock when it started to go on the fifth wave move.
Oh, wow.
So I basically increased my wealth just by
Just by that
taking the
one,
short.
yeah,
Yeah.
taking a shot, one single stock. Yeah.
Yeah.
Insane.
So, that's about being patient.
Patient. Yeah.
And I can't stress enough, a boring trader is a wealthy trader. Yeah. Because you don't need excitement. What you need
Mm,
is structure, discipline. You
mm,
need a confluent strategy that is backed up with technology. So today, technology should support your judgment, not replace it. And discipline comes first always. Um, but embrace that technology to save you time to filter out. So AI is fantastic. It crunches
mm,
lots of data. I would never
mm,
trust it to trade for me live. What I
mm,
do is I trust it to crunch the data to program the algorithms. Yeah. And
interesting.
then monitor those. Yeah. So
Wow.
we always have an air gap. So I see AI as an infant right now. Okay. Infants still make mistakes. They learn from those mistakes. And obviously, AI is growing up a lot faster than my 18-month granddaughter. But you got to embrace the technology, but be wary. And the way we've developed this app is to embrace that technology, to do all of that hard work, to crunch those 100,000 different confluence combinations to find the one, to then
Hmm.
program those 28 points of control, which lights up the lights. We still have
Hmm.
an air gap, just that double check. And we're actually, that technology that double checks that is important. But so technology is important to be able to have that multi-asset exposure, in my opinion.
Hmm.
We, but again, being patient, waiting. Sit on your
Mm,
hands.
mm.
Remember, and somebody asked me why we never set profit targets, because I haven't got a crystal ball. I don't know how far this is going to run. And back in that CIG sort of time, you don't know how far it's going to run. So taking the
Right.
profit too early, you're leaving way too much profit on the table there to actually go. So we don't set profit targets. We allow the trade room to breathe, manage it properly, reducing risk, locking in profit. When you get a runner, it really runs.
I'll tell you something funny. The reason why it resonates with me so much is because there were a couple of stocks back in the day in 2021, 2022. I booked profit too early. And I booked profit too early. It was just like it went up, I think it went up to 150% or about close to 200%. I booked it. But today, as I look back, that stock has gone up like 400%. And,
Yeah.
I booked too early.
It's the behavior. It's understanding that behavior that's very important. And technology can understand that behavior and stop you from, again, it's not about overtrading as well. It's about getting out too early. Sit on your hands,
Right.
wait for the
Mm.
technology to manage the trade
To do
for
that.
you,
Right,
rather
right.
than you take that emotional decision. 200%. Wow, I'm going to take that profit right now.
Yeah,
Only to look at it years later, you could have, quadrupled that profit. So
exactly.
use the technology to understand the behavior. Behavior is very important. And the behaviors, there's a lot of things, really, but you've got to talk about volume and price action together. If you're going to take your profits, but you've got a lot of buying volume coming in and a lot of price action all at the same time, and there's no real rejections of highs each day with higher than average volume, this thing's going to continue to go. And we can look at that on a micro level for day trading when we look at so, some people say, well, why haven't you got standard time frames? Because standard time frames don't work. We're looking at 21 minutes, 16 minutes, 13 minutes, 8 minutes. Combining that multi-dimension is very important when you're trying to smooth out and understand behavior. So just sticking to 5 or 15, actually doesn't help you smooth and have that multi-dimensional approach to behavior. And behavior is the thing that you need to understand. That keeps you in a
Mm.
trade longer, actually keeps you out of a trade as well. That erratic choppiness should stop you from getting in a trade, and filtering those out with technology is extremely important.
Love that. I think that is a great place where we can, come to a great conclusion. I hope, you enjoyed our discussion, Paul. And any last
Absolutely.
final words, that could help, whoever's listening to this, viewers and readers, to help this moment to talk about more final words about, what XBRAT AI is doing, and just as a promotion about since we are that's what we are actually doing here. So would love to have a last couple of words on that, and before that we will, and after that we will part ways.
Okay. So in reality, we've talked about it a lot, but multi-asset
Yes.
exposure for me is the future for trading. And using technology like xBrat AI, which crunches all the numbers and makes things really simple, is very important for traders now because markets will go, some certain asset classes will go quiet for a while.
Hmm.
Now you have the technology, get that multi-asset exposure. xBratAi does all the hard work for you. It's simple. It lights up lights. It sends you push notifications even to get ready. And then it'll send you push notification to go. And then it will send a push notification to adjust the stop to lock in profit. And then it will say, hey, guess what? There's economic data coming out. Let's take profit now before all the risk is there. So it's your companion. Okay.
Hmm.
It's a companion that has no emotion. It doesn't need feeding. It doesn't need to go to the bathroom. It literally sits on your phone, and there is a web app as well for those that are more inclined to do that. But you could be having a coffee, and it tells you to go long Ethereum. You
Oh
just
wow.
need to flip on your phone and go long Ethereum. So we've my main mission is to make it more accessible to more people so they don't have to sit in front of screens and do all this education and understand what behavior is on charts. We've used technology to take that need away because we live in a plug and play society. You buy a coffee machine now, you literally plug and you expect it to work straight away. And
Hmm.
that's, yes, there's still got to be a little bit of foundation that you need to do to understand that, that due diligence that we talked about. But in reality, we've taken a lot of that load off, and you just need to
Hmm.
follow the lights and the push notifications and have that multi-asset exposure.
I love that, love that. I hope we can have the discussion another time soon again when you have more asset classes and greater theories from this point to prove on.
Thank you very much, Sanjay. I really enjoyed it.
All right, thank you everyone for listening. See you in the next one.